Consumers are poised to cut back dramatically on their spending. This represents around 66% of the U.S. economy, so this would be a very big deal for economic activity on a go-forward basis. Retailers have already begun to adjust to this new phenomena, and they started discounting heavily in October, where they had discounts of around 24% on around 8% of the items. As you can see here on this table, that is up dramatically from what we've had historically. The reason for this is personal consumption expenditures have managed to outpace wage growth and also outpace inflation. So we've seen a growth in spending that should be coming down toward that trend line, because you can't outpace your spending needs bigger than what you're making on a sustained basis. The key thing to take out here is one of the reasons spending did surge is the stimulus checks that occurred during the COVID crisis. And you can see the savings rate, dramatically increased. That increased the amount of savings that have now, over the past couple of years, been spent down. You can see the personal savings surge and then came below trend. So the past 2 years, the consumer has been spending out of their savings bucket, but that is no longer capable of continuing. So since the savings are gone, consumer credit balances, credit card use, autos, etc., has managed to surge. So credit card usage has been surging. You can see that is now well up into the 4.5, almost $5 trillion neighborhood. So a big surge in credit spending. And this is occurring even as credit card rates have surged. With the rise in interest rates, credit card rates have on average gone from around 15, 16% to over 20% today. Auto loans, similar, have also increased in price. So consumers are borrowing more at a time when the interest rate on those borrowings is increasing. There's also a situation where banks are tightening lending standards. And here's a graph of bank lending standards. And you can see that the upside here is when they're tightening, and they actually loosened here back during the COVID crisis. They're rejecting more and more credit applications, meaning consumers cannot get credit even if they're trying to. And delinquencies have started to surge here over the past year. So these are various levels of consumer credit items. The red is auto, the blue is credit card, the black is mortgage. Mortgages are the thing that people pay the most. So that's actually on the low side. Student loans have been in this payback moratorium, so that's actually not been a problem. But that moratorium has come to an end in early October, so that is set to surge. And then you can see the other debt. So across the line, consumer delinquency is starting to show the stress that the consumer is under. And we've got a situation where people are looking at their incomes, they're looking at their savings, and they're borrowing more money to make that happen, but they're having inability to stay current on those new borrowings. So in our opinion, the consumer is on its last leg and should start to roll over and cut back on its spending. This will clearly hurt consumer goods companies, especially discretionary, long-lasting, durable goods. In addition to that, there's a lot of service companies that should see some cutback in spending, especially if they're just discretionary spending. And so retail in general is going to have a problem. This is also going to spill over into the credit card and banking area, where the delinquencies will start to turn into write-offs, and some of these bad loans that they've made to these consumers are going to start to hit those balance sheets. So the consumer contracting at this time has been partially offset by a surge in government spending. And as you know, the government spending has accelerated dramatically since COVID, and really did not come down as much as anticipated post-COVID. The Inflation Reduction Act had a lot of spending increases in it, and that has also boosted government spending. So the overall economic activity has been pretty strong, but that has been strong based on two items. One, consumers borrowing money to keep their spending habits going. Two, the government borrowing tons of money, almost nearly $2 trillion per year in new borrowings for the government to continue spending. So these are unsustainable. We're getting a spike in spending on those items from borrowings, and you can't borrow forever, especially as interest rates have started to go up, making those borrowings more difficult. So in our view, the economy is set to slow here pretty dramatically, and we will be cautious, especially to consumer names. Please remember, this is not investment advice. Take a look at our full disclaimer on buildingbenjamins.com, where you can also sign up for text and email alerts so you can get this information on a timely basis. Thank you and have a good day.